look at question 2. Now, it says the following trial balance was extracted from the accounting records of the Sphinx Company at 31st December 2015. So you have land and building, and the land in it is 50 million. And plant and equipment, accumulated depreciations are given. Inventory is given. You have trade receivables, trade and other payables, bank, current tax, 7% loan note, equity shares, share premium, retained earnings. Oh, I think the share premium there is 5,000. So please, we will bear in mind that that thing is here. The 5,000 here should shift to the credit side. So we will take note of that. All right. Retained earnings is also given. That's the retained earnings. If this year ends December, yeah, meaning that that's the retained earnings at the beginning. We have the draft profits before taxation. So the same thing, we need to start from our profits before taxation. So the name of the company, obviously. Look at the requirements. We are supposed to do a schedule of, so this one is a schedule of adjusted profits for the year ended 31st December 25. Put in our currency. Is there a need for us to put 00s at the top? Yeah. All right. So the draft profit before taxation figure in the trial balance has been calculated before any adjustment that may be required from note 1 to 5 below. So note 1, until January 2015, Sphinx Co held land and building at cost. Then on January 2015, they had valued them at 250, of which 80 belongs to land. So prior to this figure that we have, it was at cost, but they have revalued them. All right, then it says that 80 relates to land. No entries have been made to incorporate this valuation. The building has a remaining useful life of 20 years as at 1st January 2015. The Fed tax on revaluation is calculated at 20%. Sphinx Company makes annual reserve transfer in respect of additional depreciation charge each year. Prior to the revaluation, the building were depreciated over 50 years. Then plant and equipment is depreciated 15% per annum using reducing balance method. No depreciation for any asset has been charged. So that is your note 1, and we will take our time to break it down. All right. Then we have on October 2015, Sphinx Company acquired inventory from overseas supplier on credit for 40 dinar. The invoice was paid in full on 25th January 2016. That's outside the scope of the year we are doing it. So it means that if you know your IAS 21, that thing will be unpaid transactions. Sphinx Company has correctly recorded the purchase on 31st October, but no further entries has been made at the year end. You are giving the exchange rates to do the conversion. Interest on loan note is paid every 6 months, and the next payment is due on January 2016. The draft profit before taxation in the trial balance include the first interest payment of 7%. That was made on 1st July. So what about from July to December? It is our job. Then he also say provision of income tax, 30 million is required for each year, for the year ended 31st December. The balance in the current tax represent over or under. So I showed you, I said if it is under, which side of the trial balance will you see it? Which side?
Debit.
Debit. So you see, this question has it. So if it is over to it, so if you look for current tax here, payable, it's at the debit. So it means it's under. All right. So these are things you should remember. And it also talks about right issue. So Fins made a right issue. So this is IAS 33. So we are going to go in there, take it one by one, and use it to elaborate on the standards as we go on to handle it. All right. So let's start. Our draft profits is 166,450. So this is the figure we are coming to make all sort of adjustments on. So like I said, this is your page 1. Your page 2 will probably take care of the others, the statement of changes in equity and statement of balance sheet. Now, I will advise you that anytime a question asks you to do statement of changes in equity and at the same time a balance sheet, do the balance sheet first. Do the balance sheet first. Because if your balance sheet balance, it is the equity side we use to do the changes in equity. So you always do your balance sheet first, then replicate that one in the statement of the changes in equity. So that is an advice you can get from me on that. All right, so that's that. So let's open our second page, our third page, it will be then. And start the analysis of our adjustment. So workings 1 will be about this PPE issue. The PPE issue. All right. So the assets in there, hey, now let's split the thing well. If there is building and land together, we know we don't depreciate land. So let's split it well. So let's say land, this is a workings on PPE. Let's say building. And the next one will be the plant and equipment. So plants and equipment. Oh. All right. Now, all workings are in CDs and 30. So let the examiner know that. If you check the beginning, our balance brought down for land. So let's say the cost. We are told that this is 200, but land is 50 inside it. There's already 00s at the top, so we have to record this like this. Then this one will be the 150. Then this one is 320 equipment. And we've been giving a cum dip for them, accumulated depreciation for them. Of course, land we don't depreciate. The accumulated depreciation that you see 90,000 will be for this one. And the 200 will be for this one. So strike and get me the differences. Of course, this is 60,000. So get me the other one. This is 50,000. All right. And you were told,
The depreciation amount for plants and equipment is 1112.
yeah, 11111. Yeah, it's true.
Yes. So that side you get 208800.
All right. Then when you read this part, it told you that they revalued the thing. They revalued it on January. So you realize that there is a revaluation that has been done. There was no revaluation for this one, but they revalued it. It's now together 250, of which 80 is this one. And the revaluation was done at the beginning of the year. So it means it was done before depreciation. So the other amount will be like how much? 170. And so that sums it, makes
Yes.
the 250. So revaluation surplus is here was 30.
1,000
And this one will be
and
what? Like 110.
20,000. Okay.
Yeah. So here we didn't do any revaluation. So that is the revaluation. And you know where revaluation is supposed to go. It's supposed to go to your OCI. Take note of that. So that is what they've said here. And from here, now the thing has to be depreciated. And it says that the policy, no, it says the building has a remaining useful life of 20 years. So the building, do the depreciation. Building 20 years. We don't depreciate this one. So land. So 20 years will give you how much? And this one to because it said the building has a remaining useful life of 20 years. That's at this date. That's fine. Then it says that Sphinx has a policy of transferring prior to the revaluation, building were depreciated over 50 years. Now, that thing means something. It means a lot. This prior to revaluation and the fact that it tells you they make transfers. So I will show you what you do if they make transfers. But then this one too is depreciated 15%. So let's get our depreciation. What will be the depreciations?
For building, 8,500.
8,500. What else? The other one.
Plant equipment, 31,320.
So once you have the depreciation, don't hesitate. Go and do your depreciations. So depreciation. You have building. You have plant and equipment. So we have 8,500. We have 31,320. You've done that. So that is it. So let's get the carrying amounts of the asset, which will be our balance sheet. You go even from here, you can also go and start doing your balance sheet.
Building, 161,500.
161,500.
Plant equipment, 177,480.
Confirmed.
All right, that's fine. Now, let me show you something. This statement, whenever you see this statement in the question, be careful. Fins has a policy of making annual transfer in respect of additional depreciation charge each year. Now, when they make the transfers means that you are going to deduct something from your OCI and put it into your retained earnings. So when we say make a policy of making an annual reserve transfer, the reserve is what we call the OCI. So they are going to make it. Now, what it doesn't mean, to be able to do the transfer, we call it excess depreciation, transfer of excess depreciation. Now, it is the difference between the depreciation before the revaluation and the depreciation after the revaluation. Depreciation before the revaluation and depreciation after the revaluation. Now, the revaluation is seen on the land, and we don't do depreciation on land, but the building we do. So that is where we can do that thing from. So you ask yourself, what was the depreciation before the revaluation? The question told you that over the years, the assets was 200,000, and if you check the building part, it was 150. That's the cost, and they've been depreciating it straight line method. And it says that prior to the revaluation, it was depreciated over 50 years. So this 150 that is there, if they were depreciating it over 50 years, what would be the depreciation? So the 150 over 50 years, what was the depreciation each year?
3,000.
3,000. Okay. Now, that is before the revaluation. Now, after the revaluation, we have seen that the depreciation each year has gone to 8,500. Now, this difference is what we call excess depreciation, and it's an excess depreciation of about 5,500. So if a question tells you that they make transfers to the reserves, then it means from the reserves for any additional depreciation. So this is the additional depreciation that has come about because of the revaluation. So you are going to transfer this figure from the OCI and you will take it to the retained earnings. So that is the meaning of that statement. You will transfer that figure from the OCI and you will take it to the retained earnings. So that is what we call annual transfer from the reserves. So it means that once you get the OCI balance, you'll be taking 5,500 out of it and you'll be putting it into the retained earnings. And that thing will show really in your statement of changes in owner's equity. You have to show it. And it will also be shown in your balance sheet. So once we do the balance sheet part, you will see how this thing is planned. But that is the meaning of that statement. Anytime you hear an entity make a transfer, it means check the depreciation before the revaluation and check the depreciation after the revaluation. The difference is transferred from the reserve to the retained earnings. Ladies and gentlemen, you do this thing whether you see this statement or not. If an examiner doesn't want you to do it, he will say the entity do not make transfer. That's what they will say. They will tell you the entity does not make the transfer. So please take note of that. Take note of that. These are all tricks in exams. You should, I mean, in the course of teaching PPE, you should have been taught that anyway. All right. So that is that. So we've done with the depreciation and we will deal with this one in the balance sheet. So now we're good. Let's go then to the next note. Note 2. Note 2. And the note 2 is also about IAS 21. IAS 21. Now, so workings 2. It's about IAS 21. What does IAS 21 say? Now, it says simply that if you do a transaction, the transaction must be posted at spot rates. All transactions must be done at spot rate. What is spot rate? Spot rate is the rate at the date of transaction. Rate at the date of the transaction. That is what we call spot rate. So when we say a transaction, you know a statement of transaction. Any statement in financial reporting or accounting is a transaction. Bought goods, 10,000 is a transaction. Paid cash, transaction. They are all transactions. So when those transactions are done, you use the spot rate. That is that. So if you buy something and you pay, we must find the exchange gain or loss. So in the year, we have two types of transaction. We have settled transaction. settled transaction. That means that you bought something and you paid. So for example, if Ama bought motor vehicle on credit for $5,000 when the exchange rate at that time was 10 cedis is to $1. How will you post it in cedis? How will you do it in cedis? Well, so convert the dollar to cedis. How much will it be? And what is the double entry? You will have a motor van, right? You debit motor van and you credit your payable. How much is it in cedis? Yes.
205,000.
205. How did you get 205? If one
Is it
cedi
10?
is equal to
10
$1.
to it's one. Oh, okay. No, I'm seeing 41. Sorry.
It's 10 cedis is to $1.
50,000.
It's what?
50,000.
50,000. Okay.
50,000. Sorry.
So this is what you do. Now, when we say Ama paid the creditor when the exchange rate was 15 cedis is to $1. Then how is it going to be? So you paid. So it means that you need to debit the payable and you need to credit your cash. Now watch here. Well, how much will it be if you convert? 150.
Yes.
It's what? 150. 15 by 5,000. Is it 150?
75,000.
75,000. So do you see that if I write 75,000 here, it will cancel this thing and it will look like I overpaid the payable. So you pay your payable, you are not a philanthropist. So you pay exactly 50,000, but the cash that is leaving you is 75,000 cash. So it means the thing has not balanced yet. So that means that you need to do another debit. That is what we call exchange loss. Now, as Ghanaian as we are, that's 25,000. The interpretation of this as a Ghanaian is that you bought something when you were paying you bought the thing in cedis, it is 50,000, but when you were paying, it is 75,000. It means you lose. You are losing 25,000 cedis. This is an exchange loss because it has increased your cost. The movement of the exchange rate has increased your cost. So this is what you do. All right. But there is another one called unsettled transaction. Unsettled transactions. Now, in an unsettled transaction, it means Ama bought the thing, but she has not paid. She didn't pay in the year. That one will mean that for unsettled transaction, IAS 21 says that revalue the monetary items using the closing rate. So you will need a closing rate. You need to revalue the monetary item using the closing rate. And any exchange difference, if you have an exchange difference, that exchange difference will go to your OCI because you have not paid it. It's unsettled. When you pay, then you transfer it from the OCI to the P&L. So take note of that. So in this case, if I tell you that the closing rate is 20 cedis is to $1, which one will be the monetary item? Between motor vehicle and payable. Which one do you think is a monetary item? If you have done it in your class already, you should know. Which one is a monetary item?
Mm, mm,
Yes, which one? But anyway, have you done IAS 21?
No.
You've not done it.
Yes.
That's interesting. So now you know. So what do? You pass the transaction at the spot rate. When they pay to you, you do it at the spot rate. Any differences will go to the exchange gain or loss. Is that okay?
Okay.
Now, when the transaction is not settled, the standard says revalue the monetary item. For your level, I'll give you only 2 monetary items, or let's say 3. Bank is monetary. Trade receivables is monetary. Trade payables is monetary. Is that okay? So it means that we are going to take the payable and revalue it. We are going to take the payable and revalue. The money is 5,000. So when we revalue using 20 CDs, that will mean that the payable, which is 50,000, must increase to 20 by 5 is 100, right? The payable
Yes.
must increase to 100,000. It must increase to 100,000. So the question is, how much should I add to what is already there so that I will get 100,000? How much should I add to what is already at the credit side? Because I'm revaluing it, credit, and the debit will be my exchange gain or loss, which will go to the OCI. So how much should I add to this one to make my money go to the 100? Because 20 by 5 is 100,000. How much should I add?
50,000.
50,000. So you add 50,000. The corresponding debit is 50,000. So this one will go to your OCI because you have not paid yet. So take note. Anytime you have any issue about IAS 21, look at it. Was the transaction settled or it is not settled? If it was settled, you will settle it. The exchange difference will go to P&L. If it is unsettled, then you will revalue it using the closing rate. So that is what you do. Now, coming to our question here, you need to apply the knowledge. So it says, Sphinx on October 2015 acquired inventory from an overseas supplier on credit for 40 dinar. Now we are preparing our account in CD, so we need to convert this thing in CD. So what do you think we need to do? We need to debit inventory. So convert it. They did it October, so use the October rate, spot rate, don't forget. Use the October rate and convert the 40. So you will debit your inventory, which means that we need to add this figure to our inventory when we are doing our balance sheet. And we will credit the overseas supplier. That is a payable. Trade payable. So what is it? So listen, not to be confused. You should know that the thing he bought is 40 million dinar. So if 1 CD is equal to 4 dinar, what will 40 million be? So you do cross multiplication. That will be what? 4x is equal to 40 million. And so you divide here by 4, you divide here by 4. So what do you have? That's 10,
10
right?
million.
Then,
10. So it means
yes.
debit your inventory by 10, credit this thing, your payable by 10. Now, the next question you need to do, ask yourself is that, was it paid? The invoice was to be paid in January 2016. Our year ends in 2016, 2015. So it means that as far as 2015 December is concerned, this transaction was not paid. So if it is not paid, what was the rule? If the transaction is unsettled, what is the rule?
Revalue the monetary amount using the closing rate.
Using the closing rate. So let's revalue it. That 40 million they didn't pay. The closing rate is 1 cedi to 5 dinar. So if 1 cedi is equal to 40 dinar, 5 dinar, 40 dinar will be what? 40 will be what?
8 million.
It's what?
8 millions.
8
Million.
million. Good.
Yes.
So it means when we revalue, our payable must go to 8 million. It must go to 8 million. So what we would do to the payable so that we can get the 8 million? What should we do to the payable so that we can get the 8 million?
You would debit it by 2.
We would debit it like 2, so you would debit your payable 2 by 2, 2,000. And therefore, what will go to our OCI, which is the exchange gain, is a gain, right? Your payable reduced. That's what everybody wants. So it's a gain of 2 million. That is it. So what will we do? We will, our payable by the end of the year is supposed to go to 8,000. So that is what we need to see. Our trade payable concerning this particular transaction is supposed to be 8,000. And we also have this one going to the OCI. Have you seen that? So that is what you do. Now, if you decide to say that, oh, I will take the thing straight to P&L, you are not wrong, because up to now, there is a current discussion ongoing about this 2,000. That should it go to OCI or should it go to P&L? Now, the thing is that technically it should go to OCI because you have not paid the money. The exchange gain is not realized. It will only be realized when you do your what do we call it? When you do the payment. Technically, when you do the payment. All right. So we can decide not to add it to the P&L. We are not wrong, and put it in the OCI. That's it. But for the purpose of your exams, whether the thing is OCI or not, because you know that the transaction will be done in the next year. So assuming the transaction was even done next year, then it means that it is an event after reporting date and it's an adjusting event. So for the purposes of your exam, I will allow for you to put this exchange gain, all right, in your P&L. Is that okay? So let's go to our P&L and add an exchange gain of 2,000. But if you are a corporate reporting student, I won't allow you to put it into P&L because I'll tell you straight, let it go to OCI. But for FR, the standards are not as compared to the CR. So you can bring here exchange gain. Exchange gain of 2,000. So you just reference it as your workings too. All right, then you go. All right, so that is that. But if you also take it to the OCI at this level, that shows maturity. That's fine. All right. Now, that is it. Bear in mind that this 2,002, we will reduce our payable by it when we are doing the balance sheet so that it will get us to the 8,000. Bear in mind, we will subtract it from our payable. So if you can do the balance sheet in addition, it will help. So let's do this. You should, by the time you finish reading the question, you should have an idea what can go into your balance sheet. All right. You should be able to set up the template for your balance sheet. So Let's say we have Sphinx. Then we have statement of financial position. As at 31st December 2015. So you can set it up. For example, you know that your non-current asset, you see it clearly. It was made up of your PPE. Now, so you should know IAS 1 or yet to come to be implemented, IFRS 18. So you know you have a PPE. And the PPE, you saw the workings you did yourself. You can total it and bring it. You did it in workings 1. So you can go and total your PPE, and so that you don't forget anything. So add the PPE values together for us. Let's go and slot it in there, straightforward. The PPE figures. Add it so that we will do it straight. And per the reading, the only things that can be added to PPE at your level is IFRS 16, right of use, or IFRS 9, financial asset. Do we have those things in the question? Did we have anything? No, we didn't have financial assets. We didn't also have lease in this question. So that will end your... The only thing that is possible is deferred tax assets. So if you know your IAS 1 template, so this is what we are going to do. After the PPE, we will leave 2 lines, just in case there is any other thing we will bring, all right? So what is the total of the PPE?
418,980.
418,980. So let's go. 418,980. All right, so we have that. So we will leave 2 lines, just something comes up. We will see, because on the template of the trial balance, you know the likely things that are possible to be there. As for inventory, you know current assets, you know is inventories. From inventories, trade receivable, is that not it? From trade receivables, what do you normally have? As bank and cash, right? But this one looks as if your bank is an overdraft. So the inventory, was there something that was said about it? Nothing. We didn't have any note on inventory. So this style will help you to score more marks at stop work. Yes. If there is no note on the thing, then it means that nothing will affect it. You can finish that one before stop work. So inventory, since there is nothing said about inventory, the notes affect 1, 2, payables, land and building, all right? You see them, loans, so you see them. And if something will affect the other ones, you know. So now inventory, since there is nothing affecting it, copy and paste so that you can get your tick. That is 115,000. Receivables to nothing affected it, so 130,000 at least. So assuming that nothing is there, we don't have anything concerning our assets anymore, I can balance my balance sheet, the top part. I can balance it. And right there, you get some encouragement. Right? That's how it is. So the deferred tax that we will be looking at, we don't even have a deferred tax brought down. And if you don't have a deferred tax brought down, which means that what you are going to do is an increase. So it means that we don't have anything. So even give me this total. There's not even a deferred tax brought down so that our own will show an increase or decrease. Since there is none, when we do, it means our own is already an increase. So total it, let's get our balancing figure. This is interesting. It's a very interesting question.
663, 980.
980. So this should be your balancing figure you are looking out for. After your total asset, what do you do? Is it not your equity? Because asset is equal to equity plus liability. The equity is probably where you need to be a little careful because they said there was a right issue. Yeah, and right issues affect equities. So that one you need to be a little careful. So we will chalk on that one small. So where is the equity? Equity shares. You chalk on that one small. So when you do the issue of shares, right issue is supposed to bring in small money. It's supposed to bring in small money. So we will look at the right issue and see if it will give us, it will increase our equity capital. If it increased, then fine. Or if they tell you that it has already been done, like what I'm seeing here now, it says that on September, Fins made the right issue. This right issue was correctly accounted for on September 2015. It means they've already done it. So if they've done it, that means our job is done. It means that we won't do anything new. They've done it. Share premium. Share premium. So when we are doing this one, it means that the share capital probably started at some point. This 120 that is there, it probably started at some point, and they did the right issue to increase it to get to 120. So we will look at it. What happened? All right. Share premium 2 is 5,000, like I showed you earlier. So equity side, you don't have a problem. But the retained earnings there, you will have a problem because you need to bring in the opening retained earnings, which is 158, 150, plus your profit. The profit that you do, plus the transfer. You remember that transfer? I said you move it from the OCI to the retained earnings. So since we have done that, we knew that it was 5,500, right? Yeah, we knew that. So it will be from our revaluation surplus. That transfer will be from our revaluation surplus. So you see that foreign exchange thing could come into the revaluation at this side. All right. So take note of that. And it would have been added here. So the revaluation, what was the revaluation in the revaluation that they did in the PPE? What was the revaluation? They did a revaluation on 150, but they also told us that they do deferred tax on revaluation. So we will have to tax that. Where is it? Deferred tax on revaluation is calculated as 20%. So this revaluation that you put together here of 150, it's 140, right?
1/4.
Yeah.
Yes.
Tax it at 20%. Tax it. You tax it at 20%. What will be left?
The tax is 28,000.
Yeah, so if the tax is 28,000, what will be left?
1120 112,000.
So this 112,000 is what will be in your OCI. So that is it. And you are taking 5,500 out of it. We will demonstrate these things properly in the statement of changes in owner's equity. So it means the OCI, we had 140,000. We tax it. So post-tax, I think you said it's 1112. 1112. Then we are supposed to move 5,500 to the retained earnings. So you move it from here to here. So what will be the balance? What will be the balance?
106,500.
106,500. So you see, you are even close to finishing the work before. So that is it. You total all your equity. Then you come to your NCL. The NCL, if you check, you have 7% loan notes, 2019 loan notes. But we all know that you have to do some note 3 on it. So you have to be careful. So just write note working 3 because we will do the financial instrumenting and we will see how it will be. Then, like I said, since there is deferred tax, you will bring deferred tax. We also don't know the deferred tax yet, but we've calculated it too. You said it was 28,000, right? But I want
Yes.
us to get to the note on taxation, then we will do it, then we will bring it. So take note of that. And the note on taxation is note 4. So we will do it, but we already know that it's 28,000. But let's wait and go and do it and come. Maybe something will change. Then you also have your current liabilities. You have your trade payables. Remember what was supposed to be done to trade payables if the thing has not been done already. And we saw that. You saw what we were supposed to do. So once we finish the analysis, we will bring in our trade payables. So trade payables is, I saw 7B. Was it 7? 7,500. All right. So we already know that we are supposed to reduce it by 2,000 from the workings 2, right? We already know that. So, and let's see what the other notes will bring. If there is nothing, then that is it. But we also know that we need to do current tax. And once we do tax, we will bring it. Tax will be on workings 4. And we also know there is bank overdraft, which nothing was said about it. So you just go and slot in there. The bank overdraft is this 16,200. So we already know our balancing figure. So once we do, we will see. We know that this is 663,980, unless there is something wrong or we didn't do the top right. So that is it. You can set up the template, leaving spaces and recording the ones that there are no issues, so that when it is top work, you know you have some done. But anyway, let me hereby say that in your exams, every 20-mark question, you are supposed to use 30 minutes for it. So if after 30 minutes you have not done a 20-mark question, it means you are struggling. So stop and go and do another one you can do. Once you finish, come back. 30 minutes, 30 minutes, 30 minutes. You will still have a 6 minutes, 6 minutes, 6 minutes for each question, because technically it's supposed to be 36 minutes for each 20-mark question. But I advise that you keep to 30 minutes. So worst case scenario, if 30 minutes you have not been able to do it, do a further 6 minutes. If after 36 you have not done, maybe extend it to 40 minutes. But after 40 minutes, it means you simply cannot do the question. Start recording the ones that are easy parts. All right. So let's go back to our note 3. So workings 3. Workings 3. Workings 3 is about a loan note, which is 6 months. And remember, since the thing is 6 months, when you are doing it, be very, very careful. All right. So financial instrument, we just do for 1 year. And our year is 2015. So this one, it says the interest of this is a liability, financial liability. Interest on loan is paid 6 months. And the thing is general. So the draft doesn't, it said the draft profits before tax in the trial balance include the first interest payment. Okay, it means it already has it. It includes the first interest payment made on July. So it means there is a half we have not done. There is a half that is not done. But what is the amount itself? What is the loan? Balance brought down. What is the loan? It's 30,000. Okay. That is the loan amount. 30,000. Okay. Then what is the interest? The interest.
7%.
7%. So do 7%.
2,100.
2,100. And the payment should also be 2,100. But they have only made a payment of half. The question said the trial balance, interest or no. So it said the profit that we have started with includes half. So it means they've not done half. So they were supposed to record 2,100, but they only recorded so the payment every year is supposed to be 2,100. But this one that is supposed to go to P&L, you've been told that only half has gone. Half has not gone. So meaning that the payment that is supposed to be 2,100, they've paid only 1,050. So you are going to do the extra. You are only going to do the extra. So that is it. But you know that the payment should be what? 2,100. But in the financial statement, you were told that only half was done. As a matter of fact, if you check it clearly, this figure, the balance, this one should be the balance brought down, carried down, sorry. The balance carried down. Because if you check, this trial balance is as at 31st December. So it means every figure that you see is at the end of the year. So this thing is supposed to be the 30 here. So you realize that if they pay the 2,100, it gives you your 30. That is it. But instead of recording 2,100, they only did 1,050, half. So that means that the remaining half, we should go and do it. And that remaining half, since it hasn't been paid, will also be in our current liabilities because it hasn't been paid. So that is it. So in your current liabilities, you know there is an unwinding interest of 1,050. So that should be it. So it means that this one is done. We have unwinding interest. So that's why I said leave spaces. Unwinding interest of 1,050 not paid. So you can total this one. That will be 68,500, eh? Right? This 68,500. 2,000 minus 7,500.
Yes, please.
68,500. Good. So go to your P&L. That 1,050 they've not gone to add to finance cost to subtract from the P&L. It is your job to go and do it. So you come here, finance cost. Unwinding finance. So finance cost. They did only half. So you are supposed to do the other half. All right. So that is it. We are done with note 4. So note 3, sorry. So the note 4 is the tax. Now remember how I did the tax in the other question. We said taxation, right? And I did here CT and here what? DT. So one, we said we need the estimate for the year. What is the estimate for the year? Where did I say you will find that one? The estimate.
In the footnote.
In the footnote. So in the footnote, it said a provision of income tax of 30 million. So straight, you have it. You have that 30 million. And I told you that where does it go?
Current liability.
Current liability. So you don't hesitate. You don't hesitate. So current tax is 30 million. Just put it there. You fill the thing. You've done it. 30 million. That is it. So that place is done. All right. So that is that. Current as 30 million. Then what else did I do? I said you need another thing. So this is estimate for the year. Over or under, right?
Yes,
Yes.
So in this question, is it over or under? So you don't write it 2. Where was it positioned?
debit.
Debit.
There is
So
under.
that means that it is what? Under. So plus 2,500. It's good you learn fast. You are catching things very fast. And it is very, very good. Yeah. So the next thing is movement in what? Deferred tax. So I said the movement in deferred tax, we can get it by knowing our deferred tax brought down. Then we will calculate our balance carried down. So do we have deferred tax brought down in the question? And deferred tax is the brought down, or it can be in the footnote. The question can give it to you in the footnote, or it can give it to you in the trial balance. In the footnote, we don't have any deferred tax brought down. But in the trial balance too, I don't see any deferred tax brought down. So it means the balance is 0. Now we are the ones going to calculate our own. And I said, do you remember the formula for calculating deferred tax? The formula I gave you.
Yes.
We
So the tax rate
Tax rates
times
times
TD
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 plus
plus
RS.
plus RS. Do you know what RS
Yes.
is?
evaluation surplus.
Revaluation
Surplus.
surplus. Revaluation surplus. So we know our tax rate in this question. The tax rate in the question, what is the tax rate? Do we have it? Do we have it? Do we have it?
20%.
It's 20%. All right. So if you have 20%, do you have temporary difference? And I said temporary difference is the difference between the carrying amount of an asset and the tax base. Do we have carrying amount? Do you have tax base? In the question, do you see anything tax base? So it means you don't have any tax base. So that is 0. So it means that the only deferred tax to be done is on the revaluation. So we don't have temporary difference. If you have temporary difference, this is how you will know. The examiner will tell you that he will give you the entire carrying amount, all right, of your asset, which in this case, in some questions, you will have it because you have the carrying amount of your assets. It is done in your PPE. These are the carrying amount of your assets in some questions. Yeah, that's the carrying amount of your assets. And you don't have a tax base, which will be 0. So it means that temporary difference. Now, you see, the reason why there is no temporary difference in this question, let me give you an example of temporary difference. In fact, we have permanent difference and we have temporary difference. You see, the way the taxman calculates your tax is different from the way the accountant does it. So there are certain things the taxman will disallow and replace them. And there are certain things they will disallow, they will never replace it. For example, when they disallow your depreciation, they give you something in return. What is that thing called?
Capital allowance.
Capital allowance. So that is why we call it a temporary difference. But when they disallow an expense in your accounts and they never replace it, it means that difference is permanent. It's permanent. Call it permanent difference. But for temporary difference, when they disallow your depreciation, they will give you a capital allowance. So there is a temporary difference between your depreciation calculation and the capital allowance calculation. Now, how do you find carrying amount? Carrying amount is the cost minus accumulated depreciation. That's carrying amount. How do you find tax base? Tax base is the cost minus capital allowance. So the two will never be the same, and that creates a small difference. That's why we call it a temporary difference. So if the question didn't give you any temporary difference, now it didn't say, oh, the difference between the carrying amount and the tax base of blah, 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 was, it didn't give you, then it means you don't have. So it means that here it will be plus the revaluation surplus, which we had around 140, right? Which you had around 140,000. So what will be the deferred tax? And we did it. You remember, it was 28,000. I remember. It was 28,000. So it means this temporary difference is coming, or this deferred tax is coming because of revaluation. So the movement will go to revaluation only. It won't go to the P&L, because the only thing it is affecting is something that arose because of revaluation. And revaluation is done in the OCI. So it means this tax, this movement cannot go to the P&L. It will go to only OCI, which is 28,000. So that is that. That is that. If we have had something, a temporary difference, because the temporary difference will be coming from our depreciation, which is in the P&L. So we would have done something in the P&L. But this one, and I told you that when it happens, if you remember, I said you will split it. One will go to OCI, one will go to P&L. So now that we know the difference is 28,000, how much will go to the OCI? We said it is the tax rate multiplied by the revaluation surplus, and that is exactly what it is here. So it means all the 28,000 will go to the OCI and nothing will go to the SPL. So it means our tax is done. So the total of the tax here will go to our SPL. What is the total? That is 3,500. My machine is starting to go low battery. Let me charge before ECG takes away their. Yesterday, they disrupt my class and it spoiled my recordings. All right. So I have to do another recording on transfer pricing and share it with the students personally. Found time for that. All right. So it means 32,000 is going to the P&L. So let's go there. 32,500 P&L. 32,500 taxation. Workings 4. 32,500. Then that, I told you that the DT here will go where? NCL, right? Or NCA. It hadn't been negative. So let's go to our NCL and put the deferred tax to there. Deferred tax. Oh, we done the NCL for the loan. I didn't write it. The balance was 30,000, right? And deferred tax is 28. That makes this side 58. So it looks as if what is not in here is the retained earnings, which we need to do for the P&L side. So have we exhausted everything? We are left with the last note. That is earnings per share. But they told us that it was correctly done, so it won't have any impact. It has been correctly accounted for. But when we are doing the statement of changes in owner's equity, we will show it. It has been done. So it means, guys, just total this one. Let's find the last figure. And let's go and put it in our balance sheet to see if it will balance.
95,080.
95,080.
Confirmed.
Okay, so come and slot it in here. Let's see if it will balance. 95,080 plus 95,080. Slot it in there and let's add to see if we can get the balance and figure.
So the extension of it is 258730.
258730. So total equity.
Four nine zero two three zero
490230.
230.
All right. So here, add the liabilities. We already have 58 here. So add the rest so that you can get your total liability. Don't forget the structure is asset is equal to equity plus liabilities. So add all your liabilities.
One one five seven five zero.
115750. So add the equity. Where's the equity? This is the equity. So add your equity to this one. Did you add this 58?
Pardon?
Did you add the 58? 58 is also part of the liability. So
58.
this 58,000, this one.
The liability will be 173.
No.
You needed total liability. So 17 what?
173,750.
All right. So now add the liability to the equity.
66.
66.
663,980.
Does it balance? All right. So that's it.
Yeah.
All right. So that's it. But I hope you are monitoring how these questions are done.
Yes.
Yes, please.
All right. So that is the end for this question 2.